This is the Asia Trade. I'm Paul Allen in Sydney. The top stories this hour. A tailwind for Asia as US stocks close at their highest since President Trump unleashed his tariff blitz. Investors betting the trade war could see the Fed cut rates sooner than expected to fend off a recession. The president insisting his team is talking with China, and that's despite a firm denial from Beijing, which is demanding all tariffs be lifted. And on the earnings front, it's a tale of two tech stocks, Alphabet jumping on a sales and profit beat, Intel sliding after a weak forecast. All right, let's see how we're shaping up in terms of futures around the Asia Pacific this Friday, 25th of April. It is a public holiday in Australia and New Zealand. Those markets closed for Anzac Day, but trading as usual in the other major markets around the region at the moment. Got Nikkei futures poised very modestly to the upside. China futures also looking at a brighter open as well. We did have a pretty good day for US indexes. All of the major indexes higher. The Nasdaq leading the way by 2.75%, led by optimism around Alphabet. Also some rhetoric from the Fed that we may see cuts coming later in the year. Though the reasons for that less encouraging. Chris Wallace says he might be seeing a spike in unemployment in the US around the corner. We'll get to that a little bit more. Take a look at the Japanese yen, meanwhile 142.71. Looking at US futures, S&P futures looking to pick up where they left off, currently higher by about 1/3%. Nasdaq futures higher as well. We had a 7-year bond auction go pretty smoothly in the US. That's despite the weak demand, although perhaps those dovish Fed comments helping things along a little. The oil price range-bound at the moment, $62.82 for a barrel of crude. There was a little bit of concern that tension among OPEC Plus members, not the least of which with Kazakhstan and Iran, could end up leading to a supply war longer term. Dollar spot index a little bit softer at the moment. Well, let's get to Intel shares. They're lower in extended trading on a weaker than expected outlook. The chip maker confirming plans to cut management jobs as new CEO Lip-Bu Tan attempts a turnaround. Bloomberg's Ian King joins us now for more. So, Ian, why was the outlook so far below expectations after they had, well, a relatively strong first quarter?
Yeah, no, that's a good question, Paul. They basically confirmed what analysts and investors feared, which is that we are seeing a short-term spike in orders and demand, and that's obviously helping revenue and everything else. But that's very much a pull forward of demand is how they describe it, and that's because we're concerned that tariffs are going to send everybody's costs, everybody's prices up, so let's get what we can now. And if that's actually what is happening and then tariffs come along, then demand is going to go down in the second half. We might get a recession, we might get weaker demand was unfortunately the message that they delivered.
So we did hear a little bit about job cuts earlier this week, an intention to eliminate, slim down management. Was anything else said in this regard?
Yeah, I mean, they said they're still working on the actual size and sort of scope of these, but fundamentally it's necessary. They need to get their costs down. They set a very tight target for spending for OPEX next year of about 16 billion and said that, there's going to be some painful cuts necessary to get there. But fundamentally, it was a bit more required in terms of shaking up how Intel operates.
So this was the first appearance, of course, for the new CEO, Lip-Bu Tan, on an earnings conference call. What was his biggest message?
Yeah, I mean, it's a difficult one for him. I mean, it's only 5 weeks since he took over as the leader of the company. And really what he focused on was more of a diagnosis of what's wrong with the company. You could argue we kind of already know that, but he focused on, look, the culture needs a shake-up, and he set out some concrete measures for what he's going to do to try to shake the culture up. But other things he was a little bit more vague because they're more long-term solutions, such as we need to revitalize the products, we need to have an AI processor in the market that can take share of NVIDIA and everybody else, and obviously we need external customers for a foundry unit, that's the factories, that's really, struggling financially in the absence of any large-scale orders.
Yeah, well, huge changes, job losses, never terribly good for staff morale. Intel did publish a letter to employees. What was the bottom line there?
Yeah, I mean, again, it was a pretty stark critique of of Intel's culture said, look, we're bureaucratic, we have too many meetings, we have too many people in meetings, there's too many layers of management. It takes us way too long to make decisions, such as which new product should we concentrate on, what should we do. And he really, went to town on that and said, look, that's just not good enough, and we need to do something about that, and that's going to include job cuts, it's going to include judging managers not by how many people they manage, but the effectiveness of what they're doing. So again, this is the kind of thing we've heard in general, people say about Intel, but he, went straight to the heart of the matter and was, in his message to his employees and said, look, this isn't good enough, we're going to do something about it.
All right, Bloomberg's Ian King there on the Intel results. At the other end of the spectrum, Alphabet shares jumping in late trade after first quarter revenue and profit exceeded analyst expectations. This is thanks to its search advertising business. Net income $2.81 per share. That was a handy beat on estimates of $2.01. Let's get across now to Bloomberg Intelligence Technology Senior Analyst Mandeep Singh joining us from New York. So Mandeep, a healthy set of numbers there. What were the highlights?
Yeah, I mean, the search business clearly showed its resilience. And look, the margin expansion we saw with Google services, 300 basis points year over year. I mean, it just goes to show that they have multiple levers to pull, even though they called out softness in 2Q, and the end of the de minimis rule is going to weigh on the ad sales going forward in 2Q. But the first quarter results, especially the margin expansion, is what drove the upside.
Well, if we're going to look for any dark points, as you were speaking there, we did see cloud revenue, a really narrow miss there. What is Alphabet spending on clouds, AI as well? What's the outlook for these two sectors?
Yeah, look, when it comes to cloud, they reaffirmed their $75 billion capex, which predominantly goes through the cloud business. And even though there was a slight miss, they called out supply constraints being the reason. So I expect that to improve through the rest of the year. The real kind of uncertainty is what kind of an impact we have from the end of the de minimis rule, and whether that means the search ads business is going to see a big slowdown in growth, or it's somewhat of a tapering of growth. So that's the uncertainty. Alphabet doesn't guide their next quarter, so they kind of left everyone hanging in terms of what kind of tariffs and the Chinese advertiser pullback we could see through the rest of the year.
Yeah, so if Alphabet's not giving too much guidance there, what's the commentary around potential ad spending in this uncertain environment for Alphabet?
Yeah, look, I think what we'll find out from Meta next week is, because they give guidance for not just the next quarter, but the whole year, is what sort of impact to expect, from Temu and Shein and other Chinese advertisers pulling back because they can't directly ship their goods anymore. So there is a lot, I think, that we'll find out next week once we get the full year guidance from Meta. But for Alphabet, I mean, it's the same set of drivers. It's just that they didn't elaborate much on the call, so we can't really weigh in terms of what sort of YouTube ads and search ads impact we'll see from the tariffs and the end of de minimis rule.
All right, Bloomberg Intelligence Technology Senior Analyst Mandeep Singh there. Well, traders are re-embracing risk on the back of Alphabet's strong results. Also, dovish comments by Fed officials as global trade tussles continue to unfold around the world. Let's get over to our executive editor for Asia Markets now, Paul Dobson. So, Paul, a little bit of optimism about markets today, but as these earnings start to roll in from the US, are we seeing any reflection in the outlook and forecasts about this uncertain trade environment?
Good morning, Paul. Absolutely, yes, we are hearing that right across the board. Or rather, we're getting hints at it, and we're not getting too much explicit. And that, I think, is because the outlook is so muddy. Some people are even giving sort of split views on what their forecast might look like or what their business might look like, depending on tariff scenarios. But we have heard quite a lot from consumer focused stocks on the idea that things are going to be less rosy going forwards, the likes of Procter & Gamble. We heard from overnight the American airline companies as well, also talking about slowing demand, slower consumer spending, and that's not a surprise because the outlook is so uncertain. You don't know from day to day, let alone from week to week or month to month, what tariffs might be in place or what the business environment might look like, and therefore it's very hard to make any long-term plans if you're a company and a business, and also even if you're a consumer. You know, there's a lot of that uncertainty hanging over everybody right now, and that uncertain environment makes for a murkier outlook. So in some ways quite surprising to see quite such optimism seeping back into the US equity market overnight, but you do have that push coming from the Magnificent Seven companies again, and you do have the idea that maybe, just maybe, the Fed will have everybody's back if indeed the impact of tariffs starts to weigh on US employment in particular.
Yeah, on the subject of the Fed, we did hear from a couple of Fed speakers today. Of course, President Trump wants to see rate cuts, and the Fed's Chris Waller suggested they might be on the way, although maybe not for the reasons the president would hope. Let's hear what Chris Waller had to say.
It wouldn't surprise me that you might start seeing more layoffs, a tick up in the unemployment rate going forward if the big tariffs in particular come back on. I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
Okay, so some people might start to lose their jobs. At what point does growth become more of a concern for the Fed than inflation?
That's the key balancing act that they're having to strike at the moment. And I think that what we heard from a lot of the other thought leaders at the Fed in recent days, including Jay Powell, what he's actually alluded to is that inflation risk really is hanging over markets and is likely to be exacerbated by the fact that the tariffs are higher than the Fed had otherwise expected. And that, you know, does create that very uncertain outlook for the interest rate picture. The Fed has been so careful to try to get inflation back under control. It doesn't want to let the genie out of the bottle now. So they're going to be focused on that. It would take quite a big economic slowdown, I think, quite a big shift in the jobs and sector in order for them to switch their focus back more to the economic fundamentals and away from the inflation outlook.
Well, we've seen recent remarks towards the end of this week really put a floor under the declines we've seen in the greenback, a little bit of strength appearing now, but we've also heard from Deutsche Bank warning of a structural dollar decline as the US dollar sinking to its lowest versus the euro in a decade, got 130 there by the end of 2027. So what's the longer term outlook for the greenback here?
It definitely feels that there is a consensus view forming. The dollar has peaked in this cycle, and the outlook is lower. And I think if you look at fundamental valuations, that would certainly tell you that there's potential for a lot more dollar weakness because it has been so strong in recent years. The Trump administration is giving it a push as well because it wants a weaker dollar. But I think more importantly, and what a lot of the analysts are talking about, is the idea that there's been so much money that's flowed into US markets, be it treasuries, be it stocks, be it corporate bonds, be it investment from all around the rest of the world in recent years. And now they're being told, hey, the outlook's not so rosy. Hey, you might not be so welcome. Hey, you know, why don't you have a look at what other options around the world might look more attractive at this moment in time? That you're going to continue to see these outflows coming through from all the various different asset classes and a more of a diversification around the rest of the world. And that's why people are focusing on the idea that the dollar will be weakening across the board into the future.
All right, Bloomberg's executive editor for Asia markets, Paul Dobson there. Still ahead on the Asia trades, the latest on US tariff negotiations, as President Trump insists his team is talking to China. That's despite Beijing's denials. This is Bloomberg.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China. And so I think you have, Jeff, as usual, I think you have your reporting wrong.
President Trump there insisting the trade talks with China are happening. Earlier, Beijing denied any negotiations were underway and called on Washington to revoke its tariffs. Let's bring in our China correspondent Min Min Lo in Hong Kong. So Min Min, what do we make of these conflicting comments from the US and China?
Well, it just shows how the two countries are really at such a level of disconnect now that they don't even agree on the facts, because China says that there has been no talks of trade at all, and any claims of progress in talks are entirely groundless and lacking in factual basis, essentially saying that President Trump is lying. So should you listen to Trump or should you listen to China? I don't know. But in the meantime, China has demanded that the U.S. removes all unilateral tariffs on China. It still says that its door is open for negotiations, but it wants the U.S. to show its sincerity. And that means actually matching its actions with its words. If the U.S. says it wants a deal imposing tariffs on China, according to the Ministry of Commerce, that's not the way to go. And essentially what the Ministry of Commerce had said is this, that the U.S. is the one who initiated these tariffs, so the U.S. should be the ones to remove them as well.
In the meantime, we have China seeking to repair its ties with the EU. What's the latest there?
Yes, and this was first reported by the Financial Times, citing sources and saying that China is prepared to lift some sanctions on several EU officials. And these were sanctions that were in place in retaliation to Brussels accusing China of its human rights records. And this move will be seen as largely a symbolic gesture, because essentially it doesn't change a lot of things materially, but it is a gesture of goodwill, and it could open up a path for both sides to pick up again discussions of a trade pact, an investment pact that was put on ice after those sanctions were put in place. And this comes as we understand the EU has been re-looking at possible price commitments from China when it comes to EVs, in place of the up to 45% tariffs on EVs that were imposed last year. And again, China showed another sign of goodwill with its retaliations to those EV tariffs. The probe into French cognac, the conclusion of that probe had been delayed by 3 months, giving producers a little bit less pressure there. And we also previously reported that the EU officials are looking to make a visit to China in July. And again, the willingness for those officials to travel to Beijing, given the reluctance of presidency to go to Brussels, does show that there is intention, at least from the EU, to maybe wean off their dependence from the US amid this tariff war and to lean closer to China. And similarly from China, we have the Foreign Ministry as well putting out a statement saying that China is welcoming of these members of parliaments from Europe to visit as well.
All right, Bloomberg's China correspondent Min Min Lo there. Other stories that we're following: South Korea says it's reached an understanding with the US to prepare what it calls a July package on trade. The industry ministry says it expects a meeting with US trade representative soon. Earlier, Treasury Secretary Scott Bessent said he expected a trade-focused agreement of understanding with South Korea as soon as next week.
We had a very successful bilateral meeting with the Republic of South Korea today. We may be moving faster than I thought, and we will be talking technical terms as early as next week, as we reach an agreement on understanding as soon as next week. So South Koreans came early, they came with their A game, and we will see if they follow through on that.
Japanese Prime Minister Shigeru Ishiba says his government has agreed on emergency steps in response to US trade restrictions. Bloomberg understands that Japan intends to push back against any effort to bring it into an economic bloc aligned against China. Its lead trade negotiator, Ryoshi Akazawa, is due to return to Washington soon for a second round of formal talks with US officials. The US is said to be demanding that Russia accept Ukraine's right to develop its own army and defense industry as part of any peace agreement. Sources say US envoy Steve Witkoff will travel to Russia to raise the issue with President Putin. It's a sign that the Trump administration is seeking some concessions from the Kremlin as well as Ukraine as it tries to end a war that's now in its fourth year.
Putting a lot of pressure. You don't know what pressure I'm putting on Russia. They're dealing. You have no idea what pressure I'm putting on Russia. We're putting a lot of pressure.
Can you maybe tell us how much?
We're putting a lot of pressure on Russia. And Russia knows that, and some people that are close to it know, or he wouldn't be talking.
President Trump has signed an executive order to speed up offshore mining and seek new opportunities to pull critical minerals from the ocean floor. The order directs government agencies to speed up processes for permits and licenses, including for seabed mining in coastal waters. And this comes as China ramps up curbs on critical rare earth exports in response to Trump's tariffs. More ahead on the Asia trade. This is Bloomberg. Fed Governor Christopher Waller says it's likely unemployment will rise if President Trump's higher tariff regime is reinstated. Speaking with Bloomberg, he thinks those tariffs won't have a significant impact in the near term.
It wouldn't surprise me that you might start seeing more layoffs, a tick up in the unemployment rate going forward if the big tariffs in particular come back on. The smaller tariff world of 10 to 12%, most of the firms I talk to, they figure out they can deal with it. They kind of often give me this kind of formula. Our suppliers will eat a third of it, we'll eat a third of it, and we'll pass a third of it on to consumers. So if you're talking about a 10 to 12% tariff, it's not a big price hit to the consumers if that's all they pass through.
But economics tells us that tariffs in general are not good. So even if we get the smaller tariffs, does that still leave business on the sidelines and growth prospects lower?
Well, it is a tax, and it's inevitable that there's a tax. But however, I've always tried to tell people that, given the fiscal situation we're in, we need to get some better control of the budget deficit, and that means some combination of taxes and spending. It's just an argument, what taxes do you want to have to raise? So nobody likes taxes. I don't like taxes. But if you're going to get any kind of get our fiscal situation under control, you're going to have some tax revenue, and there's no obvious reason why tariffs should be off the table per se.
We have some tariffs in place, even though the president goes back and forth about other tariffs, but he put some on in March. When do we start to see that in the hard data?
Well, by taking off the April 2nd tariffs, you've postponed that decision till July. So we'll see some of the 10% tariffs and the auto tariffs. Some of that will start coming through particular sectors. But it's not likely to me that by July 1st, you're going to see really big impacts from it. You will see it, like I said, in CapEx and things like that have just been put off to the side. So you'll probably see some softening in the data, but you're probably not likely to see anything dramatic happen before we get a better decision from the administration what they're going to do with the big tariff package that they initially proposed on April 2nd.
Well, what will we see first? A big rise in inflation or a slowdown in growth, perhaps epitomized by the unemployment rate?
I think you could see both of them almost happen at the same time, just in the sense that, like I said, that firms have to make a decision right away to pass through. Now, a lot of firms told me they have price contracts, so they're protected for a little while until they have to renegotiate those price contracts. But they're all anticipating, if particularly the bigger tariffs, they're all anticipating they're going to have to cut costs somewhere. And the easiest thing to do when firms have 65 to 70% of their costs is labor, to start shedding some labor. So you might see layoffs start to happen about the same time you start seeing prices going up.
Getting some breaking news out of Japan. It's Tokyo CPI numbers for the month of April coming in a little bit hotter than expected. 3.5% is the on-year number. The survey was for 3.3%. That's a significant acceleration of the 2.9% that we saw back in March. Stripping out fresh food, the number is still a beat, up 3.4% on year. Removing fresh food and energy, still a beat, 3.1% on year. The expectation was for 2.8%. So Tokyo CPI continuing to accelerate. We did have some remarks from the IMF this week on Japanese inflation. Sees it converging towards the Bank of Japan's 2% target, but it might not happen until 2027, until 2026. But judging by these Tokyo CPI numbers, perhaps that inflation target may arrive a little sooner than expected. expected. Bank of Japan is meanwhile seen holding rates steady through June at this point as it continues its path towards policy normalization. Not a great deal of reaction to the yen there, 142.88, although the movement in the yen of late really more connected to a dollar weakness story. All right, joining us now from Tokyo is our next guest, Ernest Higa. He's chairman and CEO at food supplier Higa Industries. And thank you very much for joining us today, Mr. Higa. It's certainly a timely moment to have you because you supply a lot of large names in the food industry around the world, in Europe, Australia, the Americas, and in the Americas, including Tyson Foods, Simplot, and many, many others as well. Can you describe for us how globally integrated your supply chain is and how you're managing this tariff environment?
Okay, well, thank you very much for having me today. Actually, as we import food into the Japanese market, we are not directly affected at this point in time by the tariffs because we're imported into Japan. Certainly, when you look at the disruption that's being caused by the tariff worldwide, both economic and geopolitical, it's affecting certainly the financial markets, stock markets, bond markets, and so on. But we are importing food into Japan, and for us, actually, the most important figure to look at is exchange rate. And despite all its disruption, we've seen where you could say the dollar has been weakening or the yen has been strengthening. And for us, that's actually a positive direction because for the last several years, we've been in a situation where the yen has been too weak and has caused what you call cost-push inflation, whereby the cost of living has gone up and has not kept up with wage increases. So the Japanese consumer, who we sell to, has been suffering. As you know, we import 60% of our food in Japan, and almost 100% of energy is imported. So a stronger yen is actually, ironically, I believe, will be better for the Japanese economy because consumer spending being 60% versus, say, exports, which was only 16% of GDP. Obviously, we'd like to see consumer spending come back stronger. So at this point in time, knock on wood, we have not been affected negatively. And certainly if we go into global recession, that might be another story. Having said that, Japan has been deflation for 30 years, so we're already ahead of the curve.
Mm-hmm. I want to return to the Japan deflation versus inflation story in a moment, but just to pick up on your thoughts on the yen.
Yes.
I imagine you do game out scenarios, do some forecasting as well. Where do you see the currency heading, and how does that play into your decision making?
Well, so, first of all, the exchange rate plays a big role, especially if you're importing into Japan. And, no one can really forecast exchange rates. But in this particular situation where there's a lot of disruption and uncertainty, we really don't know if this will always lead to a stronger yen or a weaker dollar. And as you know, it was one of the subjects on the talks between the U.S. and Japan representatives. Now it might be off the table. We don't know where that's going. But we are looking at the yen becoming a little stronger because I think that historically speaking, the yen has been, for the last several years, actually too weak. And in 2024, July, actually the Japanese government intervened to try to strengthen the yen. It was not so successful because they are concerned about cost-push inflation and consumer spending.
Yeah, so let's talk a little bit more about that because to a population that has been so used to deflation for so long, rising prices will be an unfamiliar situation for many Japanese consumers. So how are you finding consumer sentiment in Japan at the moment?
Well, so consumer sentiment has been negative for so long. Having said that, I think that there is a sense of optimism. Certainly, when we had Abenomics, where we went to extensive monetary easing, going to negative interest rates, and also, fiscal spending and some structural reform, we didn't get out of deflation, and we remained flattened out, actually, in deflation. So we went out of a deflationary spiral. But the biggest issue was the mindset of the consumer. And so, again, the strange thing is that when we went through COVID, all of a sudden people could not spend money. And for the last 30 years, people were not spending money, they were saving. But when COVID settled down, all of a sudden people said, well, let's spend money, despite the fact that wages were not up. Having said that, just as people started to spend money, then, as I explained earlier, the yen became weak, and all of a sudden we had cost-push inflation, which has dampened consumer spending. But still, I believe the mindset is still positive. So as we go to, hopefully, a demand pull where the cost of living comes down due to a stronger yen, I think we do see a lot of, we will see consumer spending come back. And one other big factor that's happened is the huge inbound tourism that's taking place. And this has positively impacted consumer spending. And certainly the retail sector where I deal in, I sell to major retailers. I also have a retail chain myself. And I do see these figures on a daily basis. So I don't look at macroeconomic figures. I see these movements every day. And it seems to be going in a positive direction.
Well, of course, food's also a great industry to be in because people are always going to need to buy it. It is an absolute essential. So are you looking at expanding the business at all?
Well, so, of course, we are expanding. And but as I mentioned earlier, so we look at the broader picture of the economy. So food is 60% imported, and energy costs is close to 100%. So this affects the consumer as well, too, whether it's gas prices, or whether it's electricity and so on. So in general, we see if consumer spending comes back, there's more opportunity to be in the consumer space. And so we look at a lot of opportunities there going forward. Whereas for the last 30 years, as you know, Japan went from the bubble economy, or the second largest economy, now to the fourth, and possibly becoming the fifth. So it's really interesting what's going on with U.S.-Japan trade talks, because kind of looking at the macro picture, if you look at the economic relationship between U.S. and Japan, it's not only about trade figures, where there's a trade surplus with the United States, but certainly Japan has been a big investor in the U.S. economy, and most of the car manufacturers and electronic manufacturers already have factories in the U.S., but also being accredited to the U.S. market. But, if you talk about opportunities, when Japan looks at the U.S., it looks at the amazing wealth creation by the IT sector, by, all this disruptive, innovative technology, big tech, and so on. So Japan has been looking at the digital deficit with the U.S. And Japan being a recession, but can we get out of this recession? Can we replicate Silicon Valley in Japan? So certainly there's opportunities in the food space. I think there's opportunities in trying to enhance the digital deficit between the U.S. and Japan. Certainly a lot of opportunities there. A lot of people are looking at that space. So I think consumer, I think digital, I think a lot of opportunities in Japan. And I believe that the macroeconomy will finally come back. I mean, we really have gone down for the last 30 years. And having gone to business school, they told me the economy is cyclical. They go up and they go down, but Japan has been going straight down for 30 years. So I think it's about time for Japan to turn around.
All right, nice to end with a bit of optimism. Ernest Higa, Chairman and CEO at Higa Industries. Thanks so much for your time today. We have more ahead on the Asia trade. This is Bloomberg.
You'd like to see a couple of deals done, right, to show that he's willing to come to the table and make a deal, right? So if we can see a deal with Japan or Vietnam or, somewhere.
What we want to do within the European Union is move that into a negotiation that we hope can take place across the coming weeks and months.
The relationship between the EU and China, this resetting. China is a rival and a competitor in many areas, but it has to be also an ally, a partner.
They want to continue doing business with the United States. The United States will remain a major force in growth and trade.
What we need to see in the next 90 days is some clarity.
Some of our guests there discussing the latest on tariffs and the global economy as they attend the IMF's annual spring meetings in Washington. Let's take a look at how markets are tracking at the moment. We do have Japan opening in about 17 minutes time. Futures looking very positive. In fact, Japan's now about 2% away from erasing the losses that we've seen since Liberation Day. S&P futures pointing higher as well. A lot of optimism around US markets today as well after Alphabet jumped after hours. First quarter revenue, profit, all topping estimates. So a few reasons to be optimistic there. The Nasdaq had a very good day and futures pointing higher again at the moment by about 0.5%. Well, let's get to our next guest now. He runs Hunter Point Capital, an independent investment firm focused on working with alternative asset managers worldwide. Joining us now from Tokyo is the CEO, Avi Kalichstein. Avi, thank you so much for joining us today. I just wonder if we can get started with you giving us a sense of how the fundraising environment is at the moment.
Well, it's great to be with you. Here on the ground in Tokyo, we're seeing what I would say, the old joke is that a startup is a kind of a 10-year overnight success. Well, I would say in Japan, we're seeing a kind of 30-year overnight success. So I used to live in Tokyo 20-odd years ago, and I've seen a development and an awakening of the institutional investors here, particularly towards private credit. That's quite astonishing. So there's sophistication, there's interest, and we're seeing, I think, some real green shoots.
Yeah, that very much echoes the thoughts of our last guest as well, who felt 30 years was a long time to wait for a turnaround that now appears to be coming. So what opportunities specifically are you looking at in Japan at the moment?
Well, so just to take a step back, Hunter Point Capital is a capital solutions firm that makes equity and lending investments in alternative investors around the world. So we're seeing two things here in Japan particularly, one on the GP side where there's been a slow and steady increase in the development of a domestic private equity market. I'm not sure I necessarily would have predicted that, but we're big believers that there will be kind of growing new developments in private equity firms based here in Japan, run by Japanese people. So that's an exciting development, and we're keeping tabs on that. And then on the LP side, I would say big institutional investors, as I said, are focusing on private credit. About a month ago, we hosted a summit for some of the largest allocators here, representing about $4 trillion in investment potential. And they're very, very curious about new areas of asset-based finance like NAV lending, which is something that we offer at Hunter Point.
Yeah, GP and LP stake investing isn't something that we discuss terribly often. You know, this is general partner, limited partner investing. You people can become partners in a fund instead of just holders of a fund. How well known is this type of investing in Japan? Is there an educational element to what you're doing there?
I would say it's a great question. Most of what we're doing here is educating this market. So I would say in the United States particularly, this sort of GP stakes investing, where an investor will take a minority ownership position in a general partner, and that could be a private equity firm, a private credit firm, a real estate firm, or an infrastructure business. That's become quite popular and well known both in the GP community and with investors. In Europe, I would say it's a few years behind, but becoming more popular. And then I would say in Asia in general, as you say, it's not in the common parlance. So a lot of what we're doing is educating the market about the benefits of this, how firms like ours can help accelerate the growth and the institutionalization of leading alternative investment managers.
Yeah, and certainly private investing is having a moment in the sun right now, but there are ongoing concerns about transparency, liquidity in this space. How do you address those risks?
Well, I'm a big fan of transparency. I think the more investors know, the better informed they will be and the better decisions they can make. So one of the areas where we're seeing this particular kind of information debate is around the growth in retail and high net worth investing in private markets, which is a mega trend. So we're seeing tremendous amount of interest in developing alternative investment products for, let's say, at least the high net worth channel. And there you have less sophisticated investors, and so it's the incumbency needs to be on creating information and education for that group.
I just want to get your view on the broader Japanese economy as well, if we can. We just had a pretty hot Tokyo CPI inflation print there, but the yen, meanwhile, seems sort of stuck in this range between 140, 145. What's the trend line here, and how is this informing your approach to Japanese investors?
Well, I think one of the things that's going on is a flight to quality, and the Japanese environment is one of stability, one of safety, and so I think you see people moving into the yen as a result of that. As it impacts our business, quite frankly, a stronger yen is going to mean more purchasing power for Japanese institutional investors, certainly as it relates to non-Japanese investments. So there's sort of a two-sided conversation about the benefits of that, but certainly Japanese investors at the institutional level are feeling empowered.
All right, Avi Kalichstein, CEO at Hunter Point Capital. Thanks so much for joining us today with your views. We have more ahead on the Asia Trade. This is Bloomberg. Let's take a look at how Kospi futures are looking ahead of the open at the top of the hour. Looks like we're setting up for a positive day, better to the tune of 1.4%. It could be a good day for tech as well, following some very encouraging numbers out of Alphabet in the US a little bit earlier. That seems to be driving some positive sentiment for US futures as well. Okay, let's take a look at Nomura weighing a return to, well, we'll get to that story in just a moment. I want to talk about some of the other futures that we're tracking at the moment also. We've got Japan looking positive ahead of the open also. We just had some rather hot CPI numbers out of Tokyo as well, so that might put a little bit of pressure on Japanese bonds. Could slide after we had CPI coming in above estimates across the board. 3.5% on year in April, 3.1% once you strip out ex-food and energy as well. Well, Nomura is weighing a return to offering cash prime brokerage services in the US and Europe, businesses that it largely left 4 years ago following the implosion of Archegos Capital. Asia investing editor Russell Ward now joins us from Tokyo for more on his Bloomberg scoop. So Russell, Nomura's been burnt in this space before. Why is it heading back?
Morning, Paul. Yeah, that's a good question. Pretty surprising reporting we had from our colleagues here that Nomura is getting back into the cash prime brokerage business in Europe and the US. This is 4 years after it lost $2.9 billion on the Archegos debacle, and really that forced the company at the time to reinforce its risk controls and to actually pull back from that business. And so now, 4 years later, it's feeling that, okay, you know, there's a lot of volatility in the market. There's hedge funds that demand these sort of services, and Nomura feels that it can, provide those services to those clients. And so it's looking to get back into it. It's looking to raise revenue from this division, roughly triple it to around $1 billion. And it's hired a former Barclays veteran to run the business. So Nomura feels like it's put Archegos behind it, and it's ready to get back on the front foot and get back into this business serving hedge fund clients overseas.
Well, we're going to be getting some earnings out of Nomura a little bit later on as well. What are we expecting to hear?
Yeah, so Nomura's earnings are supposed to be pretty solid. The analysts are seeing about a 13% increase in fiscal fourth quarter profit. That would actually take annual earnings to a record. So that would be pretty much a good boon for CEO Kentaro Okuda as the company prepares to celebrate its centennial. So it should be good results. I think market was going to be looking out for Nomura to join Wall Street banks and posting a good quarter from trading. Particularly, remember, we saw Wall Street firms enjoy record revenue from equity trading. So, the volatility with the new Trump administration coming in really was a boon to trading, and we'll have to see if Nomura joins them. Also, deal making was maintaining momentum, particularly here in Japan. And we'll also have to be watching out for whether the wealth management business, the domestic retail business, maintain momentum, as well as just as the sort of the Japanese stock market sort of came off a little bit. So we'll just have to see what comes out in the wash this afternoon with Nomura.
All right, Asia Investing editor Russell Ward there. Let's get the latest from the corporate front now. In fact, I'll bring you some breaking news first. We're hearing from Chinese Finance Minister Lan Faoan saying he's the tariff trade war affecting global economic stability. Says China advocates resolving trade disputes via equal dialogue, and if this comes at a time, of course, as well, where President Trump insists there are ongoing negotiations between China and the US, to which China has responded, no, there aren't. So a bit of a disconnect in the narrative there, but the Chinese finance minister saying that trade disputes should be resolved via equal dialogue. All right, let's get to some of the stocks that we're going to be watching when trade opens in Korea and Japan at the top of the hour. Going to be keeping an eye on Nissan stocks after it's warned it expects to post a loss of $5.3 billion. We're also going to be keeping an eye on suppliers of Alphabet in South Korea and Japan after Google's parent reported first quarter revenue and profit that beat analyst estimates. So take a look at the yen as well. Not a great deal of movement here, 142.81. It'd be worth keeping an eye on that, though. We did have that very hot Tokyo CPI print a short time ago. Just to recap those numbers for you, 3.5% in the month of April. The expectation was for 3.3%. That was the headline number. But even once you start to strip out the volatility of fresh food and energy prices as well, Tokyo CPI in April was still running pretty hot. So it'll be interesting to see how Japanese bonds perform off the back of this. Might change the picture for the Bank of Japan. Where the market opens in Sydney, Seoul and Tokyo. Up next, this is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens and a potential positive open for risk assets across Asia. Paul, we've seen, of course, the positive leading coming from Wall Street, but also more positive headlines when it comes to trade negotiations. I'm here in South Korea today, where we heard from the Trade Ministry that perhaps we could see potentially an agreement soon with the U.S. and South Korea agreeing on a broad framework for negotiations.
Yeah, that's right. That view was also echoed by Scott Bessent on the US side, that South Korea and the US getting close on a deal, so some encouraging signs there. But as for the US-China trade agreement, well, they can't even agree on whether they're talking or not. So quite a bit of confusion on that front, Shery.
Yeah, President Trump seems to be really facing the pressure to demonstrate some sort of progress in all of these trade negotiations. When it comes to Japan, we heard from the Japanese government that they're planning to compile U.S. investment plans for their automakers. This according to NHK, a local media. We are now seeing the Japanese yen continuing to lose ground against the U.S. dollar towards that 143 level. The Nikkei is now trading higher by 1% for a third consecutive session of gains. We could, in fact, be seeing the first weekly loss for the Japanese currency this month. And, of course, we're also paying attention to what's happening in the yield space, the 10-year yield at that 134 level. We had Tokyo April core CPI rising 3.4% year on year, which was really a jump by the most in about 2 years or so. But it's really that conversation about where central banks go from here that's affecting markets in South Korea as well. We saw the surprise contraction for the first quarter that's leading to more speculation that the Bank of Korea might cut rates sooner than later. You're seeing the Korean won unchanged at the moment, but we've seen significant pressure for the South Korean currency as well. This, as we continue to hear about these trade negotiations, we heard from Secretary Scott Bessent that they could be reaching an agreement of understanding and that they could come out as soon as next week, Paul.
All right, let's take a look at how US Treasuries are tracking at the moment. We did hear from a number of Fed speakers over the past 24 hours as well. Beth Hammack said they're going to know the right way to move in June when they get a little bit more data, although she didn't say which direction the Fed might potentially be moving. We heard from Chris Waller as well, saying he'd support rate cuts if there's a significant rise in unemployment. So perhaps not the most encouraging reason to start easing monetary policy. He doesn't see a tariff impact on the economy before July, but after that point, unemployment could rise steeply. Not a lot of huge amount of movement in the bond space at the moment. The 7-year auction did at least go smoothly, despite somewhat tepid demand. Not on that board, Australia and New Zealand both closed today for the Anzac Day holiday, Shery.
Let's bring in Kelvin Tai, Regional CIO of UBS Global Wealth Management. Kelvin, what are you watching this week as we continue to see more developments on trade negotiations, but also perhaps more dovish Fed speak coming from officials?
Yeah, I think, the tariffs are likely to actually dominate headlines and drive sentiment, at least for the next couple of weeks as well. So if there is any U-turn on the tariffs where President Trump is concerned, that will likely actually bring some more positive sentiment onto the markets. But I think at the end of the day, what we really need to watch is basically the 10-year yields, because that's where, the about turn from the Trump administration came in, when the yields were actually trading above 4.5%. And I do think that above 4.5% is where the threshold is where the markets are likely to react pretty violently to any movement of the Treasury yields towards that kind of level.
What does that mean for the equity space?
Well, I mean, if the 10-year yields are above 4.5%, then the equity risk premium actually kicks in, which basically means that if you want to buy an equity, the returns have to be a lot higher than just 4.5%. So as a result of that, the movement in the 10-year yields are actually very, very important. We are mindful of the fact that the Federal Reserve will have to issue close to 10 trillion this year, 7 trillion just from simply refinancing the maturing treasuries, and another 3 trillion from the deficit that's likely to come. And of course, if President Trump cuts taxes this year and extends the tax cuts as well, then obviously that figure is likely to actually increase significantly from here. So it is actually key for the U.S. administration to try to actually keep the 10-year yields to 4.5% and below. And in fact, where we're concerned, we think that actually 4% is where it should be actually trading to in that sense. So anything above 4.5% is where I think the markets are likely to react negatively to that. You'll probably see the dollar actually weakening as well as a result of that. And of course, a combination of the dollar weakening, treasury yields going up, and the equity markets coming off will likely actually force the hand of the U.S. administration.
Yeah, I mean, uncertainty just remains the key theme at the moment. So where do you put money to work in this environment?
Yeah, well, our view is that where the tariffs are concerned, they will likely reduce and come down from where it currently is. We do believe that with another 6 to 7 months to go before the end of the year is up, that the negotiations will eventually bring the tariffs down further. And that in turn should actually be pretty positive for sentiment where the U.S. equities market is concerned. So we do still have a pretty positive outlook on the U.S. equities. On top of that, we do think that the Federal Reserve will probably have to cut rates at least twice this year, if not 3 times, each time about 25 basis points. So there you go. That's another catalyst for U.S. equities. So we do think that U.S. equities, at least at this point in time, still looks pretty attractive where we're concerned.
So if we talk about the Fed a little bit more, we did hear from Chris Waller today saying, look, he'd be ready to cut rates in the second half of the year in line with your expectations, but the reasons he want to do it are not particularly encouraging. He sees the potential for a big spike in unemployment. Do you share those sorts of concerns over the jobs market and growth in the U.S.?
Yeah, we do actually. In fact, that's the reason why we think that the Federal Reserve is likely to cut as well, because the unemployment rate is probably going to shoot up to about 4.5% in our view, and therefore that in turn will likely actually make the Fed move. We think that the Fed will cut largely because of the fact that we agree with the fact that this one-off rise in inflation is transitory, largely because this is not a demand shock. This is actually a supply shock, right? And as a result of the tariffs. So if it's a supply shock, then obviously what the Federal Reserve needs to do is to basically focus on growth and unemployment at the moment, and not on the jump in inflation, because that's going to be a one-off. So as a result of that, we do think that the Federal Reserve should actually cut. But if core inflation continues to be sticky, and remember, core inflation actually went up even before the tariffs were actually announced, then obviously the Federal Reserve's hands are actually tied, and it will be pretty much constrained. But nonetheless, we do think that 2 rate cuts this year is pretty much in the bag.
Will that give more breathing room to central bankers across Asia at a time when trade headlines are already pressuring their currencies?
Absolutely. I think you can say that for most central banks, with the exception of perhaps the Japanese central bank. The core inflation numbers coming out this morning were a bit of a surprise, but again, that is actually very backward looking. And that actually came about when the Japanese yen was basically above 155. The tariffs have actually pretty much done the job for the BOJ. They've actually forced the Japanese yen towards the 140 level. And in fact, last week, we actually broke 140. So I don't think that the Japanese central bank, the BOJ, will be in a rush to actually hike rates in the next couple of months, because I do think that they can actually potentially delay this further until data shows that core inflation is really, really rising very sharply, despite the tariff situation at the moment, which I think is quite unlikely. I do think that with the Japanese yen strengthening recently, that core inflation in Japan should actually be a little bit more milder over the next couple of months.
It was interesting that these parallel negotiations between Japan and the United States, Korea and the United States are going on, right? Because with the Japanese negotiations, it seems that currency issues haven't come up not once. In Korea, though, FX policies will be one pillar of the negotiations going forward, according to the government. So I wonder, what are the implications for Korean equities if you have a much stronger Korean won, perhaps, if we see that pressure coming from the Trump administration?
Yeah, I think that will have a pretty negative impact on the Korean equities market largely as well, because of the fact that, a significant part of the earnings for Korea is actually driven from exports. But I don't think the Japanese will get away scot-free where the currency is concerned. Don't forget that the Japanese yen is also on the US Treasury's watch list of currency manipulation as well. And if you look at the IMF's purchasing power parity value of the Japanese yen, it should actually be at around 88 to 90 against the US dollar, and basically it's now at about 140. So I don't think the negotiations will actually not include the Japanese yen as part of the package if the Japanese were to actually start negotiating on a more protracted basis with the US. I do think that will have to factor in the conversation sooner or later. The Korean won cannot move too much without the Japanese yen moving as well, and I do mean in appreciation terms, because that in turn will likely put the Korean exporters in a pretty negative light. Already this morning we've seen how negatively impacted Nissan's earnings were, and any strengthening in the Japanese yen will further put a dent in the earnings of a lot of the Japanese exporters in that sense. So I do think that where the negotiations between the US, Korea and Japan is concerned, I do think that will take quite some time to iron out, and perhaps the markets are a little bit too optimistic at this moment with regards to the negotiations between all three parties.
Kelvin Tai, Regional CIO of UBS Global Wealth Management. Really good to have you with us, of course, as we continue to watch the market repercussions. We are in the thick of earnings season. We just got Alphabet overnight, and we saw those gains in the after-hour session. Solid first quarter revenue, a profit beat, a little bit of disappointment with their cloud revenue, but anything related to tech and also Alphabet suppliers, you can see the broad upside as that risk rally continues across Asia, Paul.
Let's take a look at Nissan shares, defying gravity, better by 2.25% right now. This is after it cut its full-year operating income forecast, announced a huge annual net loss of $5.3 billion. And Nissan, of course, grappling with restructuring, falling sales and aging lineup. It's discontinuing cars to avoid a build-up in inventory. It's pretty ugly all around. But shares are rising in Japan today, now 2.4%. We got more ahead on the Asia trade. This is Bloomberg.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later, but they had meetings this morning, and we've been meeting with China. And so I think you have, Jeff, as usual, I think you have your reporting wrong.
President Trump there insisting the trade talks with China are happening. Earlier, Beijing denied any negotiations were underway and called on Washington to revoke its tariffs. Let's bring in our China correspondent, Min Lo in Hong Kong. So, Min, what do we make of these conflicting comments from the US and China?
Yes, it just shows the two countries are so far apart on their views that they can't even agree on the facts. And essentially, China is saying that President Trump is lying, that these talks have not been taking place at all, that any claims of progress of talks are groundless and lacking in factual basis. But President Trump is telling that reporter that his reporting is wrong. And bear in mind, this comes as the G20 summit for finance ministers, the IMF and World Bank meetings are happening in Washington, D.C. And so there are these Chinese officials like the PBOC Governor Pan Gongsheng, as well as the Finance Minister Lan Fo-an, are in Washington to attend these meetings. So it's actually an opportunity for both sides to meet face to face for the first time since those tariffs, the Liberation Day tariffs, kicked in April. But we haven't actually officially heard from the Chinese side that there are any bilateral meetings, although President Trump is saying the two sides met this morning. He refused to say who met whom. So a lot of mystery going on here. And of course, China is still saying that it wants the U.S. to remove all unilateral tariffs. This morning, Lan Fo-an in Washington, D.C. at the summit had said that China is still advocating for the trade dispute to be resolved through equal dialogue, and saying that the trade war is affecting global economic stability. So again, where are we with these trade talks? It's anyone's guess right now.
Well, President Trump does have some different understanding of what negotiations can actually mean and what the official version is. But we know at least that China is trying to make more friends around the world, perhaps this time with Europe.
Yes, and this was first reported by the Financial Times, citing sources saying that China is prepared to lift sanctions on some EU officials. And these were sanctions that were put in place in retaliation to Brussels' accusations of China as a human rights violator. And it is going to be a symbolic move, a gesture of goodwill that could maybe open the gates for both sides, picking up discussions of this investment pact that had been put on ice back in 2021 when those sanctions were put in place. And this comes as well as with the U.S. with the EU actually reconsidering these price commitments from China when it comes to EVs to replace those tariffs as high as 45% from the EU on Chinese EVs. So that could be another move that could put a flaw on the trade dispute between the two sides. And again, we have another gesture of goodwill from China, because in retaliation to those tariffs, China had delayed the conclusion of its probe into the French cognac by 3 months, easing off pressure on French producers. And also we had reporting saying that EU officials are planning a trip to Beijing in July, again indicating their willingness to travel to China when there was reluctance from President Xi's part to go to Brussels. Again, both sides looking to lean towards each other as they counter the risk from US tariffs.
Bloomberg China correspondent Min Lo there with those ongoing negotiations around trade. Now, South Korea says it has reached a shared understanding with the U.S. to prepare what it calls a July package on trade issues. The finance minister made the comment after high-level meetings with U.S. officials in Washington.
We had a very successful bilateral meeting with the Republic of South Korea today. We may be moving faster than I thought, and we will be talking technical terms as early as next week as we reach an agreement on understanding as soon as next week. So South Koreans came early, they came with their A game, and we will see if they follow through on that.
Let's bring in Bloomberg economist Hyo-sung Kwon here with the latest on these trade talks. And it seems that President Trump really needs this win when it comes to trade negotiations. Do we get a feeling that at least both sides, from South Korea and the United States, seem to be on the same page in terms of where they're going from here?
at this point, we don't know exactly what the U.S. really wants. So, but in terms of the talks like tariff and non-trade measures, and then economic security and investment cooperation, they are on the same page. But still, it is at its early stage of the game. It's kind of the first inning of the game. So we need to see how they shape up. Later, typically, that the trade talks or trade deals takes more than a year. Right?
Yeah. And trying to get this quick win for President Trump must be difficult, right? Especially if you want to get into deeper issues. So what could be some of those sticking points and challenges in this relationship?
So it's very, in the near term, South Korea's political instability would be a sticking point. So South Korea's delegations will be in difficult position to move forward in sensitive areas like importing beef from cattle more than 30 months old, and GMO soybeans, something like that. So that is one problem. And the other problem is that U.S.-China rivalry. U.S. wants to, gather its allies into one economic bloc against China, but China is also a very important trade partner from South Korea's perspective. So South Korea needs to balance, the U.S. demand and South Korea's own interest.
The currency issue was also discussed during the talks. How do you view its importance in the current trade context?
Current trade talks, as far as I understand, that U.S. the U.S. Treasury Department also understands very well that the South Korea's FX intervention, at least since 2022, was to defend South Korea's currency value against depreciation pressure, which means that, to simply put, South Korea intervened in the FX market to appreciate Korean won. So that I think in the working level talks, the currency issue would not be a hot topic. But having said that, U.S. could still use a currency issue as a negotiation leverage, because Korea has a persistent trade surplus against the U.S. So we need to see.
Yeah, where those negotiations go, especially on those currency issues, right? Thank you so much. Ho-Sung Kwong, Bloomberg economist, here with that South Korea, U.S. trade negotiation, the other parallel negotiations that we're following, Japan and the United States as well. Prime Minister Shigeru Ishiba now saying that he's decided to create an emergency economic package to help industries cope with the impact of U.S. tariffs. This coming after talks between Finance Minister Katsunobu Kato and Treasury Secretary Scott Bessent. Let's get to Washington and bring in our economy and government reporter, Erika Yokoyama. Erika, so what have we heard in terms of the progress that has been made here? Because we've just talked about South Korea. We know that the U.S. wants some sort of deal with Japan, one of its closest allies as well.
Sure. I was actually just out in the Japan's finance minister's press conferences in Washington, who just had a bilateral talk with his counterpart, U.S. Treasury Secretary Scott Bessent. And Kato sent a clear message that U.S. didn't bring any currency target or framework to control it in the bilateral talk. That was in line with his counterpart Bessent remarks from yesterday, where he said absolutely no currency targets. So I think they first tried to break down against the market speculations that Washington may press for a weaker dollar as part of the ongoing trade negotiations. And such speculation has mounted since President Trump called out China and Japan for currency practices that put the U.S. at a disadvantage. And also today's talk also suggested about the effects that the finance minister do not intend to cause more turbulence in the currency market and rather stick to the G7 commitment, which states the FX rate should be determined by the market and excessive moves will hurt the economy.
So what are the implications of this for the broader trade negotiations between the U.S. and Japan?
So yeah, as you know, Japan has been focusing on negotiations with the U.S. rather than retaliation, right? And the country around the world are seeing these talks between Japan and the U.S. perhaps now, like with South Korea as well, as one of the test case for how other may fare. But I think for Japan, I think it would we still need to keep monitoring the development. Only what we know so far about Japan is that the currency issues will be addressed between finance chief and outside of the entire deal packages. And Japan's chief negotiator, Akazawa, is expected to come back to the U.S. likely next week with some potential these proposal. And there are already some local reports suggesting on these potential ideas, including Tokyo increasing rice imports from the U.S. or easing rules for American car imports. But nothing has been concrete yet. And the Japanese government has been kept saying that the deal has to be presented as a packages. Also, and many speculate that the Prime Minister Ishiba himself will perhaps visit U.S. when deals are near the conclusion. So I think it will still take some time before reaching agreement for Japan.
Yeah, despite the uncertainty, at least for the Bank of Japan, there must be some relief that we have seen the strength in the Japanese yen this past month. We know that Governor Ueda is there in Washington as well. Have we heard from him?
Yes, he was also there as well. Then he signals no change in the bank stance. That means like the bank will continue to raise interest rate if the economic outlook is looking like materializing. And meanwhile, he of course remained quite cautious about the tariff impacts and uncertainty caused by that. He said he will assess various indicators and especially the data related to tariff measures. Tariff impacts will be quite crucial going ahead. Yeah, and Ueda cited few possible channels of tariff impacts. And in upcoming policy meeting, like most economists are seeing no rate hike chance, but we can at least get some hints from economic quarterly report that the bank will issue.
All right, Bloomberg's Erica Yokoyama there in Washington. We have more ahead on the Asia trade. This is Bloomberg.
European futures trading like this early in the Asia session. We saw gains in the previous session as automakers gained ground on President Trump's comments on auto parts and perhaps some exemptions on that side. The ECB also right now considering changing its monetary policy strategy to better respond to price shocks in a volatile global environment. This is Bloomberg.
You'd like to see a couple of deals done, right, to show that he's willing to come to the table and make a deal, right? So if we can see a deal with Japan or Vietnam or, somewhere.
What we want to do within the European Union is move that into a negotiation that we hope can take place across the coming weeks and months.
The relationship between the EU and China is resetting. China is a rival and a competitor in many areas, but it has to be also an ally, a partner.
They want to continue doing business with the United States. The United States will remain a major force in growth and trade.
What we need to see in the next 90 days is some clarity.
Some of our guests discussing the latest on tariffs and the global economy as they attend the IMF's annual spring meetings in Washington. Take a look at how Korean assets are trading at the moment. We're seeing broad upside risk rally ongoing here across Asia. Industrials, materials leading the gains in the Kospi right now, while the Kosdaq is up 0.6%. And the Korean won really holding steady. Of course, we had seen some significant pressure against the U.S. dollar. That surprise contraction in first quarter GDP really boosting expectations of a rate cut by the Bank of Korea. So do watch out for those bond yields in South Korea as well, because we had seen the front end yields really declining in the previous session. But really all to do also with these trade headlines that we're getting. The trade ministry here saying that Washington and Seoul have agreed in principle on a framework for trade negotiations. Let's bring in Wendy Cutler, vice president at the Asia Society Policy Institute. She previously served as the acting deputy U.S. trade representative, where she worked on a range of negotiations, of course, including the U.S.-Korea Free Trade Agreement. And Wendy, given, of course, how difficult it is to get a trade agreement, and now you see all of these threats about potential tariffs, where's the relationship between Washington and Seoul now?
Well, clearly, Korea and the United States had a good day of meetings, although the U.S. was a lot more effusive about the progress made in these talks than Korea. And so when Secretary Besson called this meeting very positive, Korea was, playing its A game. I think he's trying to send a message to the markets, but also to other trading partners that they need to get off their dime and really work with the administration to reach deals during this 90-day period.
It is a tricky situation for not only Korea, but other allies like Japan that have big business with China, right? How is Beijing really looming on these talks?
Well, Beijing is clearly looming. About 48 hours ago, it issued a very stern warning to the rest of the world that if you conclude agreements with the United States that result in agreements that run against our national interests, we're going to counter-retaliate. And I think that has sent a chill throughout Asia in particular, particularly when the U.S. is asking for countries to take various measures that's suggesting that they'll side more with the U.S. than with China.
Wendy, that puts countries like South Korea in a very difficult position, and it's not alone in this position. The US is only its second biggest trading partner. China is its biggest, to the tune of about 50% more. So how do countries reach a deal with the US that doesn't make things worse with its other trading partner, China?
Well, it's clearly going to be a challenge. They're going to need to make sure that the word China does not appear in these agreements at all and focuses more on an affirmative agenda in terms of coming up with supply chain agreements, export control agreements, and investment agreements. Again, not mentioning China, but clearly aimed at China.
Well, you were a diplomat, a negotiator with the USTR as well, and these trade deals, particularly bilateral ones, often take a long, long time to sort out. Now, considering the compressed 90-day period, the sheer number of deals the US wants to get done, does a fast deal mean a superficial deal that can mean a quick sell to the public?
Well, it seems like the administration has kind of dialed back a bit in terms of calling for detailed agreements. They're calling more now for frameworks and for memoranda of understanding or agreements in principle, which suggests to me that now they're seeking agreements kind of on the contours of an agreement with the details to be reached and negotiated following this 90-day period. And that, to me, seems more plausible than trying to reach detailed agreements with numerous countries during a very short negotiating period.
Would that be also enough to sort of ease the pressure that potentially President Trump is feeling right now to get some wins out of these tariffs that are really roiling global markets?
Clearly, it's imperative that he's able to reach a handful of deals, and hopefully, from his perspective, over the next few weeks. Besson seemed to indicate that maybe the Korea deal could be reached in the next few weeks, but the Korea readout of the meeting is talking about a July package, which suggests to me that they plan to use the full 90 days to reach some type of an agreement with the United States.
I mean, to me, the fact that President Trump keeps saying that they're talking to China and Beijing coming out saying, no, the negotiations haven't started, just really shows the disconnect between the two sides and what really President Trump considers even what negotiations are or what a deal could actually be at the end of the day.
Right. Well, look, the markets are very concerned about this impasse between the U.S. and China. So it's in the White House interest to show that there is some communication. So it's plausible today that Secretary Besson, on the margins of the IMF meetings here in Washington, talked to the PBOC chairman from China. And Trump's calling that communication between the United States and China. But clearly, China was very clear yesterday saying, look, we're not negotiating with the U.S. We're in for the long haul. And, you know, I think that China thinks that time is on their side during this 90-day period.
Yeah, and China, in the meantime, trying to build bridges with the European Union as well. Are there opportunities here for trade deals, bilateral and free trade zones as well, that exclude the U.S.?
Absolutely. I'm less worried about China striking these deals, but we're seeing a lot of activity between Europe and India and countries expressing interest in joining the CPTPP and other deals. And all of these deals are going to be at the disadvantage of U.S. exporters because these agreements will provide preferential access to those countries that are parties to the agreements. China is clearly on a charm offensive. It's having a bit of difficulties, but it is scoring some points, and I think now it's making a big push to kind of get Europe more in its court. If the reports are correct, and it's going to lift some of the bans that it's placed on some of the legislatures in Europe, that's a step forward. But I don't think, look, Europe and China have a lot of serious issues between them. While they may find areas to cooperate, I think it's a very different Europe than it was 5 years ago when they concluded the comprehensive agreement on investment with China, which China's talking about reinstating at this point. I don't think that's going to happen.
All right, Wendy Cutler, Vice President at the Asia Society Policy Institute. Thanks so much for joining us. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how markets are trading across Asia right now. Broad upside risk rally. The Japanese stock market right now gaining 1.8%. Same for the Topix, which is moving 1.5%. Even the Kospi up about 1%. Of course, we've had more positive headlines coming on trade negotiations, both on the Japan and Korea side. Scott Bessent now saying that an agreement of understanding on trade could come with South Korea as soon as next week. We also heard from a local media now saying that the Japanese government is hoping to present U.S. investment plans of its automakers very soon as well. So really, it's been a roller coaster ride, not to mention that through the earnings season, investors have been also looking for clues on how companies are navigating the chaos. Let's discuss all of this with Nina Trentman, senior editor of the Bloomberg CFO Briefing. Nina, what have you been hearing from executives lately?
Yeah, as you pointed out, of course, there's a lot going on with in the corporate world, and we're hearing from CFOs that they're trying to navigate this very uncertain environment. What I'm hearing mostly recently is actually that CFOs say, okay, well, let's actually control what we can control, given that there are so many things that CFOs cannot control these days. You pointed it out, the tariffs, the dollar, the geopolitics. And so there's a lot of things that CFOs cannot control. What we've seen in the earnings season is that companies are talking more about pricing. They're talking about supply chains. They are also talking about costs, hiring, investments. So those are all the things that CFOs can actually control. And we're seeing this effort to basically shift the messaging a bit towards all the things that are within the control of CFOs rather than all the other things that are more in control of the White House and of other governments.
Right, Nina, let's actually bring in a CFO right now. Adrian Teng, CFO at Seatrium. They're a Singapore-based maker of floating production, storage, and offloading vessels, as well as other equipment used in offshore energy projects. Adrian, good to have you with us. You're also operating more than a dozen shipyards around the world. What are you seeing in terms of business on the ground? Are you already seeing the impacts of all of these tariffs that have been put in place and the threats of tariffs as well?
Good morning, Shery, and very nice to be here. I think there is some immediate implications in terms of delayed capex decisions by some of our clients as everyone sort of looks to understand what's going to happen. But I think it's important to go back to the fundamental needs of of the world, which is energy demand. And we face this energy trilemma of affordability, sustainability, and security. And that will continue to drive the need for energy production across both oil, gas, as well as renewables. And that is a spot that Seatrium plays very strongly in.
But Seatrium has already also seen business pressured, right? Years of losses as well on your bottom line. So as a CFO, what sort of strategies do you need to adapt in this very challenging and complex environment in order to turn things around?
What we have done from day one of the merger was to create a one Seatrium operating model. As you mentioned earlier, we operate across a dozen different countries with over 14 yards. But the ability to manage production on an end-to-end basis in different jurisdiction and location helps us to diversify risk, both from a client perspective, procurement, as well as supply chain disruptions. Also, at the same time, being in these wide locations, we are able to stay close to our clients, understand their needs, understanding their changing requirements. So by staying close to our clients, by optimizing our own physical footprint, by looking at cost rationalization, as well as investing in technology, automation, and digitalization, we believe that we are able to execute projects efficiently, productively, and on time and on budget.
I'll jump in here. Adrian, thanks for joining us. Just wondering if you were thinking about the U.S., you operating a shipyard here in the U.S. as well. Do you think that the tariffs that the U.S. has implemented or is implementing will lead you to invest more here in the U.S. As you're looking towards more growth?
I think it's still too early to make that conclusion. I think Trump's policies is never absolute in terms of positive or negative. There are opportunities if one looks at the different equations. In terms of new builds in the U.S., I think one of the challenges is, of course, the talent that is available in country. And then whether that can be done productively, economically, I think is a question that still needs to be answered. In terms of repairs, maintenance outside of the U.S., there are opportunities for us to able to get some of the traffic that may have been going to China, but now are being diverted to outside of China. So there are opportunities in that sense. But I think in the long term, Trump's focus on oil and gas, whether onshore and offshore, will be a positive for us. We are very active in the Gulf of America, and that will be a positive area for growth.
How about wind energy? I know that you've also previously looked at potential offshore wind investments in the U.S., but now that stance has potentially changed with Trump. Like, will you be able to invest in other geographic areas because of that?
Sure. I mean, unfortunately, Trump's position has put I would say, a temporary stop on the offshore wind sector in the U.S. We hope that will come back in due course as energy demand in the U.S. continues to increase exponentially. But certainly, other jurisdictions, especially in the U.K., Europe, the rest of Asia Pacific, there is continued capex and investments into the offshore wind sector. We are entertaining customer inquiries. We are looking at projects that is ongoing, and we believe that will hopefully be able to balance out the slowness in the U.S. offshore wind sector.
Just wondering, actually, when you're talking to clients around the world, one of the things that we've recently been wondering about, and here at Bloomberg and elsewhere, is sort of, are we entering into a recession potentially in the U.S. but also globally? I'm curious to hear what you're hearing from your clients at this point in time. Are they moving ahead with investments? Are they pausing? What's the sentiment?
I think with disruptions and uncertainty, you do have an element of conservatism in many corporate boardrooms. And I think people are assessing the situation. I don't think anyone has a clear answer or a conclusion of the outcome, but I believe everyone, and including Seatrium, we're doing a lot of scenario planning. And against each scenario, we do have different actions, mitigants to try and overcome some of these setbacks or challenges, as well as opportunities. So everyone is going through that reassessment. Certainly, budgets that were made, in Q4 of last year no longer holds water. Everything has to be reassessed. So I would say it's a pause. The data points are still trickling in from different jurisdictions. And I think people are still having a wait-and-see position. But whilst all this is going on, we have to stay very close to our customers.
Yeah, especially given the uncertainties, right? The change in global trade environment. Adrian, we've been even hearing from the U.S. their plans to impose port fees on Chinese vessels. How consequential will that be on your business and just broader trade bifurcation?
I mean, certainly a slowdown in trade is not helpful, I think, for anyone, and especially in the maritime sector. But having said that, I think goods that are manufactured in China will still be diverted to other locations. I believe the percentage of China exports to the U.S. is actually a small percentage of the overall export volume. So in that sense, is it that consequential for the Chinese manufacturers? I think that's a question that still needs to be answered. But I believe that trade flows and shipping traffic will continue. And again, one has to look at this from a long-term perspective. Over the next decade, for sure, energy demand will continue to be driven by emerging economies, by artificial intelligence, by data centers. These are all very energy-intensive industries. And where is the energy going to come from? And it's ultimately oil and gas that will continue to be the most efficient, cost-effective, and also sustain, in a way, secured energy for many of these emerging countries.
Adrian Teng, really good to have you with us, CFO at Seatrium, and of course our thanks to Bloomberg's Nina Trentman. Do check out CFO Briefing by Nina. It's a weekly newsletter for and about CFOs, featuring top executives at global companies and covering key trends in corporate finance. Get the latest edition every Sunday. Sign up on Bloomberg.com or on the terminal. This is Bloomberg.
Let's turn now to China's earnings season. BYD probably going to surpass Tesla on a quarterly net income basis for the first time when it reports results later on Friday. BYD was also among the companies that unveiled new models at the Shanghai Auto Show. Our Chief North Asia correspondent Stephen Engel takes us for a tour of the hottest wheels on offer at the event.
Chinese EV makers are doing whatever they can to sort of tariff-proof their industry. Granted, they're not really in the United States market right now, but they do still need to appeal to the domestic Chinese market, the world's largest auto market. And those buyers here are very tech-savvy. So these offerings, the dozens and dozens of new models on offering at the Shanghai Auto Show, are laden with tech, including whatever it's doing. Those other available markets also are around the world, with countries not named the United States. This is a subcompact from NIO called the Firefly, which essentially is going to appeal to the young urban buyer. And again, it's loaded with tech. And this funky Firefly will be hitting international markets, including Singapore and elsewhere around the world, including, of course, Europe, sometime by the end of this year. Industry insiders say this little guy could be a direct competitor to BMW's Mini Electric. BYD's luxury EV brand Denza is the high end. They obviously have export ambitions. This year they're heading into Europe. This is their concept at the Shanghai Auto Show. It's called the Z Coupe. It's sort of a supercar with the wide hips, similar to a Porsche 911 or a Maserati Gran Turismo. So they're clearly going to the upper end of the sports car market, dominated, of course, by European brands. Denza Z Concept Coupe is sort of an iteration of last year's debutante, the C9, which has hit the market and is famous for its sort of crab walk parking system. Not to be confused with the strikingly similar Zeekr 007 GT. Dare I say, China is showing it is neither shaken nor stirred by the tariffs. And then there's this beast of an offering from Chinese carmaker Jetour, a division of Shery Automobile of China. It's really tapped into the growing segment of off-roading. Could this be China's answer to the Cybertruck from Tesla? They plan to bring it to market by as early as 2026, with export destinations likely in the Middle East. And finally, you know the old adage, they say that imitation is the greatest form of flattery. Well, this is Americana 1950s style on grand display from a company called Full Good from Nanjing. So maybe there is hope after all for U.S.-China relations if we could just turn back time. Stephen Engel, Bloomberg News at the Shanghai Auto Show.